Good morning and welcome to the new edition of Dr. Lamba's Awakening Call. History, human, political, economic, is full of contradictions. But there are certain rules of economics which are deemed to be inviolable, but they are not. If we look at the history of the economic development, we will find absolutely paradoxical, contradictory situations emerging. And the situation that has emerged now in the time of this coronavirus is really perturbing to many. I received a phone call yesterday and a message from a friend asking why is it that when everybody was saying that the global economy is going to tank, that we are going to face recession, the stock market is bullish and not bearish. This paradox puzzled him, nonplussed him, and so, considering his dilemma, which I assume would be a dilemma facing many, perplexing, puzzling, insoluble, but it's not. We tend to ignore one major factor, and that is that the stock market is no indicator of the economy's health. The stock market, whether it's Dow Jones, whether it's Sensex, whether it's S&P, is basically based on the performance of a limited company. For example, in India, the Sensex depends on the performance of 11 companies. Dow Jones is much more comprehensive, takes into view about 250 countries, but the major indicators are the performance of the five big ones. Same is about Nikkei, same is about Hong Kong, and same is about S&P. So when S&P, say example, rises as it rose recently on Tuesday, last Tuesday, today is again 1 week back, today is Monday, S&P rose from 0.2% in February to 3,389.78, quite a big increase. And it was high to the finishing at the highest closing level on record. Naturally, that means that this year's bear market, on a drop of more than 20% of the peak, that is from February high to the lower of March 27, and that bear market was shortest in the history. And that is because of the various factors not connected with coronavirus. Similarly, at the same time, we have seen the retirement accounts saw a sharp upward swing in the second quarter because of the uncertainty surrounding the outbreak, whether vaccine would be there or not, whether the recontamination of the coronavirus cases would be there or not. The biggest problem is that normally many more people die, but the death rate in the coronavirus has not been more than 2% anywhere. With that negligible death rate, while it was 50 million in Spanish flu when the population was less than half of what it is today. So people, the investors, boost their IRA contributions, their retirement accounts. They remain steady. And this is a record in a recessionary period. I would not say that the recession has not been there. But this recession has two currents, as in oceans, the warm current and the cold current. And when these currents combine, that would be a problematic time. At present, they are running parallel to each other. But the stock staged a stunning turnaround despite all these factors. And are you aware of the major reason? Trillions of dollars of stimulus from the Federal Reserve and the Congress propped up the American economy gripped by recession. And we know that when American economy is strong, the global economy takes its cue and becomes stronger. It's like a vitamin to the global economy. And although the stocks are back at the high, let's not forget that the millions of out of work Americans still suffering from a mind boggling 56 million workers who are unemployed just in 21 weeks. But then again, the welfare economy set in. They started getting their benefits. And when they started getting their benefits, they started spending. And it's a curious human nature that in times of need, people spend on two things. One is on the food, and the other is on the luxuries. And the spending on luxuries is because of the fear who knows what's going to happen tomorrow. So let's enjoy today. And when the luxury products are consumed, then naturally the big ones like Apple and Microsoft and Google, they're all high tech companies. They don't provide necessities of life, and their stocks rebound. And when the stocks rebound, naturally the Dow Jones, the S&P, they go up. And at the same time, because of the stimulus by the trillions of dollars, for example, on August 8th, the latest figure, the number of Americans seeking jobs dropped to just 900,000 from 56 million to 963,000. It's more than the peak, which was 665,000 in March 2009. But still, from 56 million to 963,000 is quite something. So the job creation has been responsible for boosting up the market. The unemployment rate, which was 10.2 in July, compared with a pre-pandemic jobless rate of 3.5, is the lowest in the half century. Then there's improved consumer spending. When the stimulus was given, when the money was given, people, what do? They start spending. So there was a rebound in the housing market, and better than feared corporate profits have added to the investors' optimism. And naturally, that resulted in. Now, the question arises again, the fundamental question: is it possible? Is it economically sound? Let's not forget that the stock market is very resilient, and it's more resilient in the times of downturn. The higher stock prices during recession are not unusual. Stocks have, if you look at the 12 recessions, historical study, starting with World War II, there have been 12 recessions, and in 7 of them out of 12, stocks have risen, and the median advance has been 5.7%. So if In 7 out of 12 stocks have risen. So if the stocks are rising this time, it should not be a matter of wonder. Wall Street has clawed back the last of the historic frenzy losses by the new coronavirus. And on Tuesday, as I said, it was the highest that has been there till now. As a matter of fact, the S&P's 500 milestone caps a furious 51.5% rally, which became not now. It began in last March when coronavirus fears were still there. People were dying, but then the people had a hope. So this is now up nearly 5% of the year. And the biggest problem, as I said, is high flying stocks, Apple, Microsoft, Google. They are much more advantageous in this new economy. Now, this is something new which has happened. Work from home. When the people started working from home, they went high tech. When went high tech, naturally the demand for the products of these computer giants, IT giants increased, and their stocks form the base of Dow Jones, S&P, Sensex. Do you know for the first time Apple, the first publicly traded company, valuation this Wednesday was $2 trillion. Now imagine if one company has $2 trillion, it will reflect on the stocks, and the stocks will define. And then, as I said, you have got to see that the difference between the stock market and the economy. There's a curious thing again. Each stock market has a different base of calculation. S&P 500 is driven by the manufacturing, while the US GDP, the broadest measure of goods and services, is propelled not by the manufacturing but by the service sector. And the service sector has taken a hit due to social distancing, lockdowns, and the consumer spending on the consumer goods. But the high tech good, which are the base of the stock market, so they went up. So GDP comes down, stock market has gone up. And this is because of the change in the modes of work. And this benchmark index is global. Roughly 40% of the sales from S&P 500 companies is derived internationally, while in US exports are just 13% of the GDP. So when there's a huge market, the stock prices going up is not something perplexing. Another thing, investors view the market as forward looking, anticipating how the US economy and the corporate earning will perform in next 6 to 12 months. And now optimism is growing because, excuse me, optimism is growing because of two factors. One, the Cambridge Oxford combined for the vaccine. Results have already come up and it's being tested. So the hopes of a vaccine and further stimulus hopes by the government is propping up. So the pillars are being built below the roof so that the roof doesn't fall. And economic data has improved the parts of the country. They have reopened. And as you get closer to the vaccine and therapeutics, which is important, next 6 to 9 months are going to see a upward swing in the stock, but not necessarily of the economy. And the lightning reason is that though the economy is still suffering, that though there is an uncertain path and millions of people are living on unemployment, the hope of the vaccine on the corner, the performance of the high-tech companies is propping up all hopes. And that is why there is the growth in stock market, though normally there should have been a slump. But again, let me warn that this growth is on the basis of performance primarily of the high-tech companies. For example, Apple, Microsoft, Amazon, Facebook, and Google, parent companies, are up by 16%. So what's the future? Stocks would be poised for more gains in the coming months. One key reason, investors are betting. It's a speculation. People are saying that this might continue this trend of home work from home. And secondly, the hope that the coronavirus might come to an end because of the vaccine. And the large rallies in the stock market are followed by continued gains. So S&P 500 has averaged 46% return in 12 months, which is unique. And this is based on analysis of data going back to 1932. So the hopes of vaccine, the hopes of another package from the government, you would find that the stock market in the next few months is not going to dip down. It's going to go up. And this seemingly contradiction of stock market booming is not something out of the ordinary. It's based on the robust principle of a the reasons how the stocks are evaluated, the market return, and pari passu the downfall in the GDP. I hope you understand that this is not something unique. It has happened in 7 recessions. World War II, hopes of the peace, return to the normal. Same, the hope of return to the normal sustains the economy, and the performance of the high tech is responsible for ensuring the stock market's not survival, but the bullish trend. The bear trend was there for a very short time, and that would have been an exception if that had continued. Thank you.